Kevin O'Leary lives by one rule. If a company doesn't pay him a dividend, he won't touch it. While most investors chase hype and headlines, Kevin bets on something much quieter but way more powerful: cash flow. In this video, I'm going to show you and John exactly why Kevin O'Leary only invests in companies that pay dividends. I'll break down his no-nonsense approach to picking stocks and how his top investments have turned into wealth-building machines. I'll walk you through his actual ETFs like OUSA and OGIG and show the dividend-paying stocks inside them that are fueling serious long-term gains. And in the end, I'll show you exactly what happens when you follow Kevin's strategy and invest just $10,000 into his top 3 dividend stocks. You'll see how one stock can grow into a portfolio worth over $2 million and how another can start paying you nearly $50,000 a year in dividends. But before we get into the nitty-gritty of stocks and numbers, let's zoom out for a second. To really understand why Kevin O'Leary invests the way he does, you've got to get inside his head. And it all starts with one simple mindset. If a company doesn't pay him, he's not interested. Kevin doesn't chase hype. He's not looking for the next big thing or hoping for some massive stock to skyrocket overnight. He's after something way more dependable: cold, hard cash. Every time he invests, he wants the company to pay him back, not just with promises, but with real money. That's why he's obsessed with dividends. To him, a dividend isn't just a nice bonus, it's a signal. It tells him the company's not only making money, but it's managed well, has discipline, and respects its shareholders. No dividend? No deal. But hold up, where does that money come from in the first place? What makes a company capable of paying out those consistent dividends? Now, when Kevin's sizing up a company, there's one number he checks almost right away: free cash flow. And yeah, the name sounds a little technical, but stick with me because this is where things get real. Free cash flow is basically what's left over after a business covers all the essentials: paying employees, keeping the lights on, and investing in future growth. It's the money they didn't have to spend, but chose to hold on to. That leftover cash, that's the gold. That's what lets companies pay out dividends, buy back stock, or just stack up a safety cushion for rougher times. To Kevin, a business that doesn't generate solid free cash flow is like a restaurant that's always full but never turns a profit. It might look busy, but it's barely surviving. That's not a business you want to own. Kevin's rule is simple: if a company isn't printing free cash, it's not going in his portfolio. This focus protects him from risky bets and helps him find stocks that not only survive, but thrive. Companies with consistent free cash flow tend to navigate economic downturns with less stress. They're less likely to take on debt or cut dividends, which makes them more attractive in the long term. He believes free cash flow is what separates hype from substance. Anyone can report good earnings with clever accounting, but cash flow doesn't lie. It's cold, hard evidence of financial discipline, and that's the trait every company in Kevin's portfolio has in common. Next is the principle that Kevin calls non-negotiable, one that's built directly on this foundation of positive, consistent cash flow. Kevin O'Leary has a strict rule when it comes to investing: never buy a stock that doesn't pay a dividend. It's not just a preference, it's non-negotiable. For Kevin, dividends are more than just cash. They are a signal. A company that consistently pays out to shareholders is telling you that it has real profits, real discipline, and real accountability. If a business can't afford to send even a fraction of its earnings back to investors, what does that say about its financial health? Kevin doesn't want promises. He wants performance. And a dividend is the most honest performance review a company can give. It tells him quarter after quarter that the business is strong enough to reward its owners, and that's exactly what shareholders are. Also, dividends do more than just put money in your pocket. They reveal a lot about the company behind the stock. Kevin O'Leary loves them because they're like a financial report card. When a business consistently pays dividends, especially growing ones, it signals stability, profitability, and smart leadership. Kevin believes dividends act like a built-in financial filter. When companies commit to paying out dividends, they're forced to run tighter ships. They manage their capital more carefully. They're less likely to blow money on bad acquisitions, bloated projects, or flashy ideas that don't turn a profit. That makes them safer bets for long-term investors, especially when the market turns rough. Dividends also shape investor behavior. Kevin often says, dividend stocks turn you into a business owner, not just a speculator. You're not hoping for a moonshot, you're collecting returns like clockwork. That consistency builds confidence, and it helps you stick with your investments through volatility because even if the price dips, your income doesn't. This is exactly why Kevin avoids non-dividend stocks entirely. If they aren't sharing profits today, he's not interested in what they might do tomorrow. It's a mindset shift that rewards discipline, filters risk, and favors stability. It's why Kevin's portfolio is full of companies that last and why following this one rule could change how you invest forever. All right, so we've talked about cash flow and dividends, that's the money coming in. Now let's talk about what really turns that income into serious wealth over time. Think of dividends as the fuel and compounding as the engine. It's what keeps everything moving and speeding up. Kevin's a big believer in this. He's always talking about reinvesting dividends. And here's why. Every time you get paid a dividend, instead of pocketing it, you use it to buy more shares. Those new shares then pay you more dividends, and those dividends buy even more shares. It's this beautiful loop, a financial snowball that just keeps rolling and growing. Let's make this easy with a simple example. Say you invest $1,000 into a stock that's priced at $20 per share. That gets you 50 shares right off the bat. Now, this stock pays a 4% annual dividend, which means in your first year you'll earn $40 in dividends. Not life-changing, right? But here's where the magic starts. Instead of taking that $40 out, you reinvest it. At the same $20 price, that gets you 2 more shares. Now you've got 52 shares. In year 2, those 52 shares each pay a 4% dividend, which means your dividend payout is now about $41.60. Doesn't sound like a big difference yet, but again, you reinvest. Now you're up to 54 shares. By year 3, those 54 shares are earning even more, close to $43.20 in dividends. You buy more shares with that, and the snowball keeps rolling. Each year, your portfolio is generating more income than the last, not because you're adding more money, but because the number of shares and the dividend income keeps growing on its own. That's compounding in action. It starts slow, but it builds. This is why Kevin emphasizes holding on to quality dividend-paying stocks for the long run. The longer you stay invested and reinvest those payouts, the bigger the compounding effect becomes. In the end, I'll show you exactly what this compounding effect can do to $10,000 when you invest in Kevin's top 3 dividend stocks. You'll see how one stock can grow into a portfolio worth over $2 million. And how another can start paying you nearly $50,000 a year in dividends. Now let's take this theory and look at how Kevin applies it in practice through his own ETFs. He built 2 ETFs that reflect his strategy in action, OUSA and OGIG. Together, they show how Kevin balances dependable income with long-term growth potential. First up is OUSA, the O-Shares U.S. Quality Dividend ETF. This fund is Kevin's bread and butter. It focuses on high-quality U.S. companies with strong balance sheets and a history of steady dividends. It's got a nice mix, around 25% tech, 16% financials, 14% healthcare, all reliable, proven sectors. The dividend yield isn't massive, sitting at about 1.48%, but the key is consistency. It pays monthly, which makes it super friendly for long-term investors who want that steady cash flow. And it has delivered over 113% total return since launch. For investors who want consistent income and low drama, OUSA checks every box. Now, Kevin does have a growth-focused ETF for investors if they like, and that's OGIG, the O-Shares Global Internet Giants ETF. This is Kevin's growth play. It targets large-cap tech and internet-focused companies worldwide, prioritizing revenue growth and strong cash flows. It's 52% in tech and 29% in the communications sector. But this is not a dividend ETF. Now let's look at some of the strongest dividend-paying stocks inside Kevin's portfolio, companies like Visa, Home Depot, and MasterCard, which have turned consistent cash flows into serious long-term gains. Take Visa, for instance. It doesn't scream dividend stock. The current yield is only 0.68%, but don't let that fool you. This thing is a total compounding machine. Kevin loves Visa, not because it pays a ton today, but because it pays steadily and grows like crazy. Here's what makes it special. Over the past 10 years, Visa's stock price has climbed an average of 17.9% every single year. That's huge. And on top of that, its dividend has grown at an average rate of 17.4% per year. So even though the starting yield looks small, it's growing fast. And when you reinvest those payouts, the compounding effect gets seriously powerful. Let's say John puts $10,000 into Visa today and reinvests every single dividend he gets. After just 1 year, his portfolio would grow to $11,858. Fast forward 10 years, and it'll be valued at $54,900. Stretch it to 20 years, and John's portfolio will be worth $300,591. And by year 30, his initial $10,000 is projected to reach $1,641,605, paying around $8,170 in annual dividend income, or about $681 per month. Out of that, $53,363 would come from reinvested dividends and a massive $1,578,241 from capital appreciation. That's a total value added of $1,631,605. It's the kind of compounding machine Kevin looks for. Not just income, but exponential growth over time. Next up is Home Depot, and honestly, this one is textbook Kevin O'Leary. It's everything he looks for in a company: profitable, predictable, and straight up generous to shareholders. Right now, it's got a solid 2.49% dividend yield, which is already higher than most of the big-name stocks out there. But here's where it really shines. Its dividend grows fast, averaging about 15.68% a year. That's not just good, that's elite. And the stock itself, over the past decade, it's delivered an average 12.74% annual return just from the share price climbing. That's a combo Kevin loves: steady income today and strong growth for tomorrow. Let's say John puts $10,000 into this stock today and reinvests every single dividend he gets. After just 1 year, his portfolio would grow to $11,523. Fast forward 10 years and it'll be valued at $42,566. Stretch it to 20 years, and John's portfolio will be worth $196,756. And by year 30, that initial $10,000 is projected to reach a massive $1,014,274, paying around $49,379 in annual dividend income, or about $4,115 per month. Here's the breakdown. $281,855 of that growth comes from reinvested dividends, and a huge $722,419 from capital appreciation. The total value added to the portfolio, $1,004,274. That's what happens when dividend yield meets long-term compounding. Exactly why Home Depot is a pillar in Kevin's dividend-focused strategy. Last one is MasterCard. At first glance, it doesn't look like a standard dividend stock. The yield is just 0.55%, which isn't going to turn heads. But that dividend is growing at an average of 18.06% a year. And the stock itself? It's been climbing at a blazing 19.4% annually over the past decade. So let's say John puts $10,000 into this portfolio stock today and reinvests every single dividend he gets. After just 1 year, that portfolio would grow to $11,995. Fast forward 10 years and it'll be valued at $61,496. Stretch it to 20 years and John's portfolio will be worth $376,113. And by year 30, that initial $10,000 investment could grow to an astonishing $2,289,411, paying about $7,109 in annual dividend income. In total, $45,868 of that growth would come from reinvested dividends and $2,233,543 from capital appreciation, meaning the value added to the original investment is $2,279,411. New to investing? Click the video on the screen to see how to turn a daily $10 investment into a $3 million portfolio.